Lots of action in the fixed income market this week, with inflation reaccelerating, investors pricing out rate cuts, and Treasury yields pushing toward 20-year highs. April's inflation read came in above expectations at 3.81%, driven by a steady increase in core services and a jump in energy prices tied to the conflict in Iran. Unlike the reaction to hot inflation numbers several years ago, equity markets took the news in stride as the AI investment cycle and strong corporate earnings have largely decoupled stocks from interest rate sensitivity, although sustained higher prices ultimately do pose risks to consumer spending and confidence. The key question for investors is whether recent inflation readings are a bump or the start of something more serious. The historical precedent that market observers worry about is the experience of the 1970s, where after inflation initially jumped and then moderated for several years, a second wave took inflation as high as 15% until the Federal Reserve under Paul Volcker broke it by raising interest rates to 20% and pushing the economy into a recession. While we think the risk of a repeat is unlikely, the pattern of inflation in this cycle compared to 50 years ago is notable. That said, several key factors point against a repeat. For instance, the US economy is less unionized, and today we're more services oriented. Also, the US is far less energy dependent on foreign producers. Critically, central bankers have the experience of the 70s in mind when making policy, which brings us to our next point. Investors are no longer pricing in further rate cuts. The federal funds rate upper bound sits at 3.75%, and futures markets now have the Fed holding there through December of 2026, with the possibility of a hike by mid-2027. We doubt that incoming Fed Chair Kevin Warsh is keen to raise rates given his recent commentary and the implicit assurances he likely made to win the nomination. That said, stubborn inflation pressures may make it difficult for him to convince the FOMC to vote for a cut until there is clear evidence that inflation is under control. The silver lining for investors is the potential opportunity in fixed income. With 3% inflation proving stubborn for now and the economy still growing at a healthy clip, Treasury yields are approaching 20-year highs across the curve and offer positive real yields above the inflation rate. For those seeking income, we think that holders of Treasuries are being reasonably compensated relative to risk that they're taking in the asset class. If interested in discussing strategies for allocating to Treasuries or any other investment matters, please reach out. Thank you and have a great weekend.